Everything in this video is not intended as financial or investment advice and is for educational purposes only. I'm Josh Olszewicz, the head of research at Valkyrie, and let's take a look at the midweek market update. More of the same, really. Been talking about inflation and the Fed, maybe since we started videos on this channel for Valkyrie, since we started doing these updates. And that continues to be the focus. Now, this is Trueflation, a real-time estimation of inflation. Last month's CPI came in at 6.4. Trueflation currently reporting on a daily basis at 5.22. Now, there's two possibilities here. Either CPI will finally take into account this month-over-month change from January to February, or CPI, because it's calculated slightly differently, the methodology is different, has flattened out along with Trueflation. And the worst case being CPI continues to increase. And the reason the laser focus is on this right now is because the Fed is getting in between decision times when it comes to another 25-point hike, which is looking more and more like a 50-point hike. You know, at this current time, based on what the Fed's been saying, governors of the Fed, what the data's been saying, some people think it should be a 50. And I think the CPI print on March 14th, which is a couple weeks away still, will be the deciding factor for the meeting on the 22nd. Now, based on the meeting probabilities, we're continuing to see this 25 basis point probability degrade. And we're also seeing a rise of probabilities above 6%. Now, that doesn't mean we're going to 6%, but it gives you an idea of where market sentiment is. On Friday, there were even probabilities at 6.25 to 6.5. So that just goes to show you how bearish the market was on Friday on the probabilities. Bearish on risk, rather. Bullish on rates rising. Currently, a rate reduction, a pivot, a true pivot, is not being priced in at all. That also has changed. So we have a lot of time between now and the 14th and the 22nd. We have a lot of time between meetings on the 22nd and then May 3rd. If markets are expecting a 50 and they get a 25, and markets are expecting a 25 and they get a 50, there's going to be a lot of volatility. If markets are pricing in a CPI decline, and that isn't the case, right, we're going to get volatility. So we continue to be driven by economic data releases and whether or not terminal rates are near, far, or somewhere in between. Very uncertain time, and risk does not like uncertainty, and what is not uncertain is rates on US Treasuries right now. 6-month rate currently at almost 5.25, which is extremely high historically over the past 20 years, let's say. So many people just parking cash that would otherwise be in risk assets into a risk-free environment, and that certainly will put a damper on risk markets in the meantime. As far as crypto is concerned, the SEC continues to enforce certain individuals or entities. This time today, they decided to announce a charge against one of the FTX engineers. Great, clean up the streets, get them out of here, throw the book at them. We don't want them in the industry. What they did was old-fashioned fraud, and that's just all there is to it. So they deserve any and all charges brought against them, in my opinion. On a brighter note, on the Bitcoin side of things, before we go into dark mode here, I'm going to talk about Ordinals again a little bit. So Ordinals are NFTs on Bitcoin, viewable through the Ordinals protocol. Without the Ordinals protocol, no one can really tell what's going on an individual basis. These NFTs are basically minted onto specific Satoshis, which is the smallest unit in Bitcoin. So we've had 216 inscriptions, which is well beyond proof of concept. This is definitely the beginning of potential. Depending on your opinion on this, I don't really have an opinion other than if the protocol allows it, go for it, right? And if you are anti-Ordinal, I would suggest lobbying to get the protocol changed. But that's currently not the case. Currently, anybody can do this, and they can, most importantly, spend money doing this and generate fees for the security budget for miners. They've generated 1.35 million in total since this began. And I think we're going to continue to see NFTs migrate to Bitcoin. We're going to continue to see a flight to quality to Bitcoin. This is all really good for Bitcoin not so much for other layer ones. But this doesn't require an additional token. This doesn't require an additional network. It all can be done within Bitcoin. And we're already starting to see, this was yesterday, they announced Yuga Labs. Again, I'm not a big NFT guy. I get it. It's not for me. But to see development happening on Bitcoin, it brings eyeballs, it brings users, it brings new people who maybe were all about different coins that aren't Bitcoin into Bitcoin. That's the most important thing, okay? So people are going to try this out and find out if they like it, if they hate it, if they want it changed, right? You're going to see development, just like DeFi, just like ICOs, all this other stuff that's happened elsewhere outside of Bitcoin, which arguably was a good thing, but also brought attention and eyeballs away from Bitcoin. So we're starting to see that pendulum swing back to Bitcoin. I think that's how this needs to be framed, along with arguments against this. That I'm fine with that. But the reality is, this is a good thing for Bitcoin because fees, right? If people are willing to pay money to do this, great, right? In a bull market, when this stuff's going crazy, it might be a problem for transaction fees. But if that's the case, people can use Lightning. And ultimately, I suspect this technology will eventually be ported over to Lightning. So we're still in this discovery phase. We're still in this exciting, fun phase. And that's what Bitcoin really needs. And that's what stuff like Doge or stuff like these random altcoins, these meme coins that you see, they get eyeballs and attention because they're fun. And this stuff, to some people, is extremely fun. I'll also mention Coinbase basically went all in on Ethereum, announcing Base, which is a layer 2 scaling network. No additional coin here as well, which is important. And basically their justification here is they want to use it to onboard the next billion users to allow scale. Very hard to do high scaling on layer 1s currently, which is why things like Lightning, things like Optimism, Arbitrum, Polygon, layer 2 initiatives have taken rise as we've seen a need for quicker, better, faster, stronger scaling. So net, I think this is a great thing for the ecosystem. It certainly tips Coinbase's hand into Ethereum, which isn't really a surprise. They've always been very pro Ethereum. So again, doesn't look great for altcoins way down the curve from a utility fundamental basis if one of the biggest US exchanges is going all in Ethereum, right? Now this can be ported over to many chains at the end of the day, and likely will be, but Ethereum is definitely where their heart and mind is at. From an on-chain perspective, Bitcoin, utility, if we're talking about transactions here, now you can see this rise in transactions, partly related to price, but really mainly, I think, related to the NFT stuff and ordinals. There aren't a lot of people, looking at on-chain activity again, there aren't a lot of people just moving Bitcoin around right now. There are a lot of people holding Bitcoin. There are a lot of old holders, old and cold, as they like to say. It's remaining old and cold. They aren't moving coins around. They aren't panicked. They aren't excited to sell here. Like myself, right? I'm in it. I'll show a chart in a minute. But I'm in it for post 2025, post 2040, whatever it is. That's why many of us are here. And you can see that based on the behavior of coins on chain. So transactions up slightly, realistically out of a multi-year range. So that's bullish. But this is utility right here that you're looking at. You don't have to agree with the utility, but it is utility. Active addresses also quietly rising here, slightly. And new addresses as well, kind of a more obscure metric that not many people talk about, also generally rising here. So this is a good thing. This is what you want to see on any network. Bitcoin's hash rate, which basically is another way of saying how secure is Bitcoin, because you'd have to acquire 50% of the total computational power, 51%, to enact nefarious activity. It's extremely difficult, extremely expensive. There's no way you could do that quietly. In any case, that continues to increase here, the hash rate at over 300 exahash. And this is in large part due to US mining infrastructure build out, North America infrastructure build out, and just really random off-grid use cases that we're seeing popping up all over the world. So it's no surprise that hash rate's up here. Currently, I think it'll start to relax. But if price takes off, then that will incentivize more hash rate to come online to the network. So it's kind of a give and take here between mining revenue and Bitcoin price. They certainly decoupled, in recent months as price was declining, hash rate kept rising. So we'll see what happens once price starts rising, if that is the case. But I wouldn't expect hash rate to come off significantly if mining revenues increase. And on the layer 2 side of things for Bitcoin, Lightning network capacity continues to increase. On Lightning, you can basically send small amounts of money, let's say less than $500 realistically, maybe less than 5,000. It kind of depends on many factors there, but these aren't high value transactions per se. These could be microtransactions, these could be remittances, these could be tiny micropayments just in general, subscriptions, that sort of thing. But one way to measure activity here is total network capacity measured in Bitcoin, exceeding 5,000 BTC up here now. So that's a new all-time high as well. And again, fairly agnostic as far as, there's no relation necessarily to price here. It's more or less, is there utility? Is there a need for the capacity? Then the capacity will be continuing to increase. And my read on this is, despite the downturn in price, we are seeing continued utility in several emerging markets, South America, the Philippines, South Africa, kind of all over the place that you'd expect. And as we migrate to some ETH on-chain analysis, Bitcoin and Ethereum on exchanges both continues to sit at multi-year lows here. This is the COVID high was basically the same for Bitcoin and Ethereum, but since then, coins have continued to come off exchanges and into self-custody or into staking. And there have been fewer and fewer reasons, especially over the past year, to hold coins on an exchange and to not hold them in custody that's safer than an exchange. Before we get to ETH, I just want to mention too that stablecoins, BUSD under regulatory scrutiny, Binance under regulatory scrutiny, BUSD can only ever go to zero at this point. It can never be issued once it is redeemed. And you can see the glory, the heyday that was essentially the FTX collapse. And the big winner here is Tether, which continues to see inflows, and another stablecoin called True USD, TUSD, which I don't have on here, also seeing inflows. USDC here in the orange, fairly stable, but the big winner, definitely Tether, as competition just continues to get knocked down thanks to regulators in the US or let's say unsavory practices on Binance's side relative to what it should be doing with BUSD and what it shouldn't be doing with BUSD. Looking at ETH transaction data, this kind of doesn't tell the whole picture, similar to the Bitcoin graph, because I'm not including layer 2 transactions on here. And as we get more layer 2 capacity and more layer 2 connectivity, there's less and less reason for most people to use Ethereum on a layer 1 basis, unless there's an incentive to do so, or that is the only way to transact, or there's some new utility unlocked here similar to Bitcoin, right? You're probably not going to see a giant jump in transactions anytime soon on Ethereum. This was the ICO heyday, right? This is new quote unquote utility. Then you're seeing DeFi take off, new utility. You're seeing NFTs in here as well, new utility. So whatever that next new utility may be, that's when you'll likely see a spike in transactions again on ETH main chain. But in general, as layer 2 is available, you may see a continued decline on Ethereum layer 2 transactions. Ethereum layer 1 transactions. And if we look at active addresses, this is kind of all over the place. That's why I like to bump this down maybe on a monthly average. But again, the general trend here has been a decline since the peak in May 2021. Much like the ICO mania phase, this was DeFi mania, this was NFT mania, and it may take years to unlock whatever the next utility is going to be, or the next killer app, let's say, to bring new and active addresses onto the chain. We can look at new addresses as well. And this to me is probably the best example of, this was ICO, absolute madness, right? Where you had to have ETH to participate in these ICOs. And much like here, where for the most part, you needed ETH to send transactions on DeFi, to participate in NFTs, that sort of thing. And currently, we're not really seeing a giant uptick in new addresses. It's fairly flat. So not entirely bearish, but there clearly isn't a giant impetus right now to use ETH on the main chain for most people. Most people in general, if they have ETH, like myself, you're staking it, right? You're not really using anything in DeFi. Much like the US Treasury argument versus risk, if you can get a yield with your ETH, the DeFi yield has to beat the quote unquote risk-free rate. The risk-free Ethereum rate is the staking rate, right? And in DeFi land, it's pretty hard to beat that right now. That isn't to say that it's going to be forever, but right now it's hard to beat that. ETH staking rate. ETH continues to burn supply. This is a supply change since the proof of stake transition. You'd think eventually, based on supply-demand dynamics, if we are in a bullish environment, that this will start to perk up again as far as price is concerned, not supply. Supply is continuing to get burned off here. And ETH is continuing to get deposited into the staking contract. So certainly have some expectation that eventually, once demand picks up, price will pick up as supply is diminished, continues to diminish, right? It's capped. It's only declining. So move on to some technicals. On the BTC side of things, this is a representation of the halving, block reward halving periods here. The next one coming up in April 29th. And really previously to the ordinals sort of exploding, coming onto the scene, we kind of had most people just sort of sitting and waiting for the next halving, and that's really not where you want to be. You want to see continued utility and activity. Now we're seeing that on Lightning, yes, but the more the better. So if we can do some modicum of simple smart contracts on Bitcoin, love it, right? Anything that adds utility and a use case is great. It still can be the best money in the world. It still can be a great unit of account, medium of exchange, and for many people, store value. Also on here, I've got the power law corridor, which was created as a line of best fit based on the previous 3 all-time highs. So you can kind of see in a general sense where we fit. To me, looks like we're closer to the bottom than the top here. And I also have the 200-week moving average, which historically has been where the markets have ranged or bottomed in previous bear markets. And another thing to sort of pay attention to here that you can glean is price relative to halving. So in general, relative to halving, market bottoms have been, let's say, about a year out. So we're nearing that sweet spot now where it's starting to line up. If the next halving is anything similar to the previous 3, and we see price appreciation basically a year after the halving. So from a technical perspective, it makes sense. From a fundamental perspective, it makes sense. And now we just have to sort of see it play out in real time. If we look at Bitcoin on the daily, this kind of looks like, chalk that's been washed on the sidewalk. There's a lot of stuff on here, but ultimately it's saying like, look, this was a downtrend the entire year of 2022 and then some. We're currently above the bearish downtrend channel. We're above the Ichimoku cloud on the daily, and we're basically sandwiched in between the 200-week moving average and the 200-day moving average. So I think patient traders, investors are hoping for a 20 to 22 price retest, and we very well may get that considering macro headwinds, CPI, FOMC, that sort of thing. Alternatively, you've got breakout traders who are ready for the 25K breakout, potentially. So there's, as we range here, there's 2 sides of this. Ultimately, both cases are bullish, so long as we maintain the course here as far as the range is concerned. And ETH is very much the same here. Slightly different in the structure, but the outlook is exactly the same. ETH could theoretically almost revisit the local low and be completely fine from a trend perspective basis. I still like 2000 for ETH based on the yearly pivot, based on the range high in August. I think that was leading up to the proof of work, proof of stake transition. And this is kind of what you're looking at, on a zoomed in basis. Does this resemble Wyckoff accumulation? I think it does. It's not perfect. It's not pretty, but it's, for me, close enough, especially considering the FTX explosion in all of this. Now, some would argue that maybe we are, on this stage, this phase of Wyckoff accumulation, and we're waiting for this spring, right? I think that's fair. I think for me, we're somewhere closer to this area. Historically, this is the 2015 Bitcoin fractal, the most textbook example you're ever going to see of Wyckoff accumulation. But I don't know if we'll see this spike this spring down. But again, range traders are waiting. They're patient. They would love to buy Ethereum around 1,000 or sub 1,000. And I think breakout traders are getting ready for 1,800 plus. And you can be both as an individual, certainly. Lastly, I'll just round it out with the SPX, which has just continued to sell off on strong economic data. Good news is bad news. The Fed signaling potential for 50 instead of 25. And just this litany of everyday new information coming down the pike here for where the country might be headed within the next 6 months. So that's all for this one. This video is for informational purposes only, and the opinions expressed are not financial or investment advice. All opinions are my own and do not reflect the opinions of Valkyrie Investments and its affiliates. No fiduciary obligation or duty exists or is created between you and Valkyrie Investments or its affiliates, including me, by virtue of any opinions expressed in this video.